Welcome to this walkthrough on how to find short volatility plays. When you're trading earnings, one of the most effective setups is profiting from IV crush, selling options that are overpriced heading into earnings and collecting when the realized move comes in smaller than implied. The challenge is, which names consistently deliver less than expected, and which are to avoid. Let's dive in. We'll start from the calendar page. Set the view to all week so you can scan for opportunities across the entire upcoming earnings week. Next, let's clean up the table. We only want stocks with liquid options, so apply that filter first. Then, toggle on the overvalued filter. This narrows the list to names where the implied move priced into options is actually higher than the average historical move. In other words, you're seeing where options traders may be overestimating the potential. Next, you can sort by lowest average move or lowest standard deviation. Either way, the names that usually move the least rise to the top. That's your first shortlist of candidates worth digging into. Make sure to also check the data pick screen. This feature highlights the best candidates for each earnings strategy using data-driven criteria and organizes them into 3 categories: prime, favorable, and to watch. These criteria will make sense in just a moment as we continue the tutorial. Long and short volatility updates daily to take into account the latest market data. While these are not the only tradable opportunities, you can still research freely through the calendar. DataPicks puts the most data-driven setups directly on your radar. For each stock that looks interesting, open the Moves Analyzer. Start by comparing recent moves to the historical average. Is the stock consistently muted around earnings, or have there been big surprises creeping in? Use the timeframe filters to zoom in on the last 2 years, 5 years, and 10 years. What you want is stability, small average moves, and low standard deviation across all windows. Check the distribution of past moves. This shows how often different-sized earnings moves have occurred. For short vol, you want a contained distribution with little to no extreme outliers. Pay close attention to the percentile figures. Make sure the 80th or 95th percentile isn't unusually high. Next, scroll down to the expectations versus reality section. This is where things get even more interesting. First, check the hit rate, how often the actual move beat the implied move. For short vol, you want this number to be low. A low hit rate signals that options usually overprice the stock's earnings volatility. Then, look at the amplitude skew. When the stock does beat implied, is the miss meaningfully larger than the beat? For short vol, you want the right number to be greater than the left number. That means that basically, when it beats, the move is only a little bigger than implied. And when it misses, the move is much smaller than implied. So even when we're wrong, the loss tends to be statistically limited. Once you've identified a few strong candidates, take them into the simulator. Here you can test strategies like short straddles, short strangles, or iron condors. See how they would have performed given both the historical behavior and the current pricing setup, and calibrate a position that fits your risk tolerance. Finally, you can also use the vol scanner. This tool works in real time to surface the most favorable positions, short straddles, condors, and other premium selling setups across all earnings. It does so by comparing break-even levels against past average moves and highlights opportunities with different risk profiles, so you can choose the setups that best fit you. Go ahead and research different stocks. Build some positions and paper trade them. Don't hesitate to reach out if you need anything.